Most people know that money is a touchy subject, but many don't realize this is why they often make bad decisions. In the book, The Psychology of Money, Morgan Housel explains how to avoid these emotional traps. In this video, I'll share the 6 main lessons I learned. By the end, you'll be better at handling your emotions about money. Let's get started. Wealth is what you don't see. Morgan tells a story about a man who drove a fancy car, a Porsche, to a hotel. The man looked very successful and rich because of his car. People at the hotel admired him and thought he must have a lot of money. However, a week later, the same man came back to the hotel, but this time he was driving an old, cheap car. The hotel staff was surprised and curious about what happened. It turned out that the man had to sell his Porsche because he couldn't afford it. He had bought the car with a lot of borrowed money, and when he couldn't keep up with the payments, he had to sell it to pay off his debt. The man wanted to look rich instead of actually being rich. This story shows us an important lesson. We often think people are rich based on what we see. If someone drives a nice, expensive car, we automatically think they have a lot of money. But the reality might be very different. Having a fancy car might mean they have less money saved because they spent it all on the car. If the person had saved the money instead of buying the expensive car, they would have more money in their bank account. True wealth is having money you can use when you need it, not just spending it to look rich. It's perfectly fine to have expensive things if you can truly afford them without causing financial stress. But if you spend money just to show off and make others think you are rich, you will end up with less money. The man in Morgan's story wanted people to think he was wealthy, so he bought a fancy car. In the end, he had to sell it because he couldn't afford it, showing that he wasn't really rich. Being truly wealthy means having money saved for emergencies and for the future. It means being able to pay your bills, take care of your family, and enjoy life without worrying about money. It's about financial security and peace of mind. So, instead of spending money on things that make you look rich, focus on saving and investing your money wisely. This way, you can build true wealth that lasts and gives you financial freedom. Money buys freedom. We've all heard the saying, money doesn't buy happiness. While we might agree or disagree, we can all agree that money can buy something very valuable: the ability to control our time. Being able to do what we want, when we want, with the people we want, brings a lot of happiness. This freedom is a privilege we can have if we have enough money. Money also gives us choices. People who live paycheck to paycheck can't afford to miss work when they're sick because they need the money for bills. Those with little savings can't take time to find a new job if they get fired and might end up in stressful jobs they dislike. But people with 6 months of savings aren't afraid of their boss because they know they can afford to look for a better job. Those with even more savings can take lower-paying jobs with flexible hours. Saving money gives us better choices and more control over our lives. Being reasonable is more important than being rational. From all the lessons in the book, this one is the most important. When making financial decisions, we often look for the option we think will give us the best results. Instead, we should look for the one that lets us sleep well at night. Let me explain. My friend Jack wants to start investing and has $5,000 to use. It's a lot of money for him, but he is confident it will go well and he won't need that money anyway. The market has been growing lately, so he thinks it's the right time. He now has 2 choices. 1. Put all $5,000 in at once and wait for the market to grow. 2. Invest $500 each month for 10 months. Option 1 looks better. He thinks the market will grow quickly, so it makes sense to invest all at once. He chooses this option. A week later, the market crashes. Jack panics and can't even look at the app. Eventually, he decides to sell and loses half of his money. A few years later, Jack tries again. This time, he chooses option 2. The first month, he buys $500 worth of stocks. A month later, the market crashes. He's already losing a third of what he invested, but he's not worried. He still has money left, so he buys $500 more. When the market goes up, he profits. When the market goes down, he buys more at a cheaper price. In his mind, it's a win-win situation. He knows he's not making the biggest profits, but he sleeps well, and that is far more important. Nothing is free. Every investment has a hidden cost, and it's not money. It's emotions like fear, doubt, or stress. The problem is, we usually don't realize this until it's too late. Instead of seeing it as a necessary cost, we feel like we're being punished and we hate it. The solution is to understand the emotional cost of each investment and be ready to deal with it. Let me share an example. My friend Matt bought some Bitcoin a few years ago for $7,500. He believed in it and put in a lot of his money. At first, he was happy because Bitcoin's value went up to $15,000. But then, it dropped for a whole year, going down to $2,500. Matt felt terrible every time he checked the price. He questioned his choices and thought about selling. But he held on, and 3 years later, Bitcoin went up to $55,000. It looks easy now. He just had to buy and wait. But Matt's success came with a huge emotional cost he didn't expect. When investing, always remember there is a price to pay. Think of it as a fee, not a fine. Play your game. Let's meet two investors. The first is a father with a good job looking to grow his savings over the next few years. We'll call him the long-term investor. The second is a young man in his mid-20s who just started working and likes daily trading to make extra money. We'll call him the short-term investor. The short-term investor loves fast-growing stocks and makes quick profits by buying and selling within hours. The long-term investor likes companies he believes will be great in the future. Sometimes these companies are the same ones the short-term investor buys. As more people invest, the stock price goes up. But one day, the trend collapses. The short-term investor gets out before the crash, so he's fine. The long-term investor who plans to hold on to his stocks takes the hit. This happens all the time. Trending stocks attract day traders, causing prices to soar. Long-term investors jump in, not realizing others are playing a different game. When the crash happens, they regret it. In the long run, they might profit, but in the short run, they take an emotional hit. So be careful from whom you take advice, because they may not be playing the same game as you. Room for error. My friend Rick was never careful with his money. He spent his paychecks on fun stuff like trips, eating out, and gadgets. He never saved any money. When Bitcoin started rising, he decided to invest $11,000. He thought it was a great opportunity to make more money quickly. At first, Bitcoin's value went up and down, but overall it grew 5 times. Rick was excited about the potential profits. However, because he hadn't saved any money, he found himself in a tough spot when he needed cash. One day, Rick really wanted to buy a motorcycle. Since he had no savings, he had to sell his Bitcoin at half the price to get the money for the motorcycle. Rick missed out on making 5 times his investment because he had no savings to fall back on. This situation shows how unpredictable the world can be and why it's important to always plan with room for error. Here's what you can do to avoid Rick's mistake. 1. Emergency fund. If you think a 6-month emergency fund is enough, make it 9 months just in case. Having extra savings can help you handle unexpected expenses without needing to sell your investments at a bad time. 2. Save more. If you're saving to buy a house in 2 years, save 20% more each month. Prices might be higher than you expect, so saving extra can help you reach your goal, even if costs go up. 3. Safety margin. Always add a safety margin to your savings and investments. If you have enough money saved early, that's great. If not, you'll be glad you saved a little extra to cover any surprises. Rick's story teaches us that it's important to be prepared for the unexpected. By saving more and planning with room for error, you can avoid financial stress and make better decisions for your future. Thanks for watching. Subscribe for more weekly investment tips and leave a comment below. Happy investing!